These market movers coming as the S&P 500 joined the Dow Industrials Friday and turning positive for the year. Joining us right now is J.P. Morgan's Private Bank Global Head of Equity Strategy, Stephen Rees. Stephen, good to see you.
Great to see you.
So really, we have seen a change in this market, certainly from the doomsday days of earlier in the year when we had the worst beginning of any year for the stock market.
It's pretty incredible. We've had a major shift in sentiment. I think oil rallying back has really helped get people a bit more comfortable. Obviously, the Fed last week providing a slightly more dovish statement. The market's actually slightly above our year-end target, and we're not raising that at this point. We think the first quarter earnings season is going to be tough, but there still are things for clients to do. We actually recommend reducing some of your broad market exposure in favor of sectors that have lagged. Places like consumer discretionary and even healthcare to us looks pretty attractive. Considering adding some short-term protection, looking at dividend strategies, which I think makes sense in this environment, as well as looking beyond the U.S. and Europe and Japan, which have actually lagged.
I want to ask you about first quarter earnings because I know, Kevin, you have thoughts on this too. But in terms of commodities, iron ore is surging again this morning in Singapore, up above critical levels.
Sure.
Oil back close to $40 a barrel. You said that's part of the sentiment change, but how important is that, and would you buy into these rallies?
We're not chasing the oil rally. We actually think it's set for a pullback in the short term. A lot of what we've seen is technical short covering in the oil markets, but it has lifted a big cloud over the energy sectors. I think people feel like the worst is behind us. We're a bit more cautious than that.
Yeah, I think one of the things that people need to take away from this market, that is, if they don't think it's richly valued, it's at least fairly valued. Sure. And so that's a general consensus. So you're talking about reducing broad market exposure, but also at the same time, we need to look at what's driven this market, right? We've seen the dollar get weaker, and that's even in the face of divergent policies from central banks around the globe, where we should actually be getting stronger. Sure. So what are those dividend names that you're talking about that people should get into?
Well, I think we're not chasing places like the telecom and utility sector, which are up 13 to 14% year to date, but there are a lot of great dividend stories in places like healthcare, consumer discretionary, financials, even technology that offer 3% plus dividend yields. And if we're talking about a Fed that potentially is moving slower than originally thought, we're at our target. If you can collect 3 to 4% yield for a good growth story, I think that's a smart strategy in today's environment.
Do we want to avoid the earnings cycle that's coming up in 4 weeks? I mean, for people to position their portfolios now after this big run-up, do you want to get ahead of next earnings season that's looking to come down 7%?
We're 10 days away from the end of the quarter, and then we'll get the earnings in the first 2 weeks of April.
Part of the reason why we're not changing the targets, I think the first quarter earnings season will be difficult. The good news is consensus is already there, calling for a 7% decline year over year. I do think there's a case as we move towards the back half of the year for a better earnings picture as we start to get easier comparisons from a U.S. dollar perspective, and also oil. I mean, if oil has seen the bottom and we're in a range of 30 to 40 to 45 potentially, you're going to start to see better or less negative earnings trends in the energy sector in the second half.
It's a better earnings picture offset by the uncertainty of what will be, regardless of who the nominees are, an intense political race.
Yeah, I mean, you've got the U.S. elections, you've got the Fed, which is likely to move in June. I mean, there's enough things out there to still warrant caution, which again, you look at the market multiple today at 16.5 times earnings. Where's the upside? The upside has to come from earnings, and we just don't see that now until we move into the back half of the year.
And there's a backdrop here, Doug High, and that's the story of the economy. And that's been the story that's really playing into Donald Trump and sort of the anti-establishment.
Yeah, absolutely. And we see that economic anxiety throughout the country. And whenever we hear good economic news, we also get bad economic news coming with it. So whether unemployment rate falls, we may see, obviously, the underemployment rate stay steady or improve a little bit, but not much that people are feeling it. There's anxiety throughout the sector. We'll see durable goods go down when we get another good set of economic news. GDP, obviously, is not where we need it to be.
We get GDP out this Friday, and we get durable goods out, I think, on Wednesday or Thursday.
Yeah. The actual economic data in the U.S. we think is pretty good. And we made a big call early in the year that we weren't going to see a recession. We were buying the pullback. That was the right call. I think from here, we're expecting steady growth around 2% GDP and a continuation of solid data.
I think investors need to also take away that in the past, when we were growing at 4% GDP, the market was trading at 15 times earnings. Right now, 16.5, 17 times earnings with GDP growing at 1%. You have to be extremely cautious. And you're talking about those dividend names in the tech sector. Microsoft is one that is trading at a reasonable price with a high dividend.
Yeah. All right. We'll keep watching that. Stephen, great to see you.
Great to see you, Maria.
Thanks so much. Stephen Rees, J.P. Morgan.